Looking to invest in your retirement but not sure where options are available? Then let's take a look at the 4 retirement plan options that are typically available to most folks. Jared here, back with another episode of Minding My Money Mondays, a common sense talk about money matters. First up, defined contribution plans. Think pension plans. Now, not all companies offer these. However, people who go into professions such as teachers, police officers, firefighters, and other government workers usually are eligible to have a pension plan or defined contribution plan. Now, the reason why it's called a defined contribution plan is because the employee doesn't contribute to it, and the amount that you get is based off of the years of service. So, the longer you stay at the job, the more money you get. When I worked at Pepsi, I was eligible for a pension plan. However, you had to stay 5 years until the money vested or you became eligible. And unfortunately, I left at like 4 years and 2 months. So guess what? No pension plan for me. Next up, pre-tax employer plans. Think things like 401ks and 403bs. Unlike defined benefit plans, the amount of money that goes into the retirement plan is based off of the amounts that you contribute, not your employer. The amount you can invest is determined annually by the Internal Revenue Service, and in 2022, that amount is $20,500. One benefit of these plans is that the money comes out pre-tax, so it actually lowers your taxable income. So if you're looking for a way to save on taxes, then consider contributing to your 401k or 403b. The next set of perks is that the money grows tax deferred, and you don't pay any taxes on the money until you take the money out in retirement. So the longer you contribute to the plan, the bigger your account balance grows. And this is exactly what you want, a large retirement balance. Now, while this isn't true for all plans, some employers will give you what is known as an employer match. And what this is if you contribute to the plan, they'll match your contributions up to a certain percentage, like between 2 and 5%. Essentially, this is free money going into your retirement account. So if you're going to contribute to a 401k and 403b and you have an employer match, make sure you contribute enough to at least get the match. Next, after-tax plans. After-tax plans are those in which you contribute money after taxes have already been deducted from your check. So think of it this way. Instead of your employer taking the money and putting it into your retirement account before they give you the check, you're taking the money that's in your bank account and investing it after the taxes have already been taken out. The most common type of after-tax plan is an IRA, and they come in 2 different flavors, traditional IRAs and Roth IRAs. And similar to employer plans, the amount that can be contributed every year is determined by the IRS. In 2022, the maximum amount you can contribute to an IRA is either $6,000 if you're under the age of 50 or $7,000 if you're over the age of 50. The main difference between the two is how they're taxed. With a traditional IRA, your money is taxed when you pull it out in retirement, whereas with a Roth IRA, the money is not taxed when you pull it out. So given this, one might be asking, why doesn't everyone just contribute to a Roth IRA? Well, that's because there are certain income limits, and if you're above those income limits, then you can't contribute. In 2022, those limits are $144,000 if you're single and $214,000 if you're married. Plans for the self-employed. Now, if you work for yourself, either as a sole proprietor, you have an LLC, or you have your own company, then the options are slightly different. You have available to you SEP and solo plans. Now, these plans will have similar names to the employer plans like SEP IRAs and solo 401ks. The biggest 2 differences with these and employer plans are that 1, the employer is the one who makes the contributions, not the employee, and 2, the contribution limits are ridiculously high. In 2022, you can contribute to a SEP IRA up to $61,000 or 25% of your W-2 or self-employment income, whichever is less. Our company, Wilson Rogers & Company, has a SEP IRA, which means that I have the potential to have ridiculously large amounts contributed to my retirement plan. It's just one of the perks of working for your own business. So if you're self-employed or you have your own business, consider checking out SEP and solo 401ks. Now, with all the options discussed, the key to making them work is time. Check out this video right here to see how time can work against you if you're just simply putting your money in the bank. And check out this video right here to learn how my man Rockefeller talks about how time and interest can work together for you.